There are three principles. One is called personal account, one is called real account, one is called the nominal account. Personal account is one which deals the accounts of person. A real account is one which deals the accounts of the property. A nominal account is one which deals the accounts of profits or losses. The person one who gives, his account should be credited. The person one who receives, his account should be debited. Transaction means transfer of property from one person to another person is a transaction. Hello my dear students, I am Dr. B.S. Subramania, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, Mysuru. In this session, I am going to hand Fundamentals of Financial Accounting, First Semester, Unit 1, Session 1, BCom, in favor of Theoretical Framework of Accounting. Today, in this session, I am going to explain what is accountancy, what is an account, what are the principles of account, what are the business cycles are, how will be adopted. Basic concept I am going to explain for you. We'll move on. Accounting. Accounting is defined as an art of recording, classifying, and summarizing a significant manner and in terms of money transaction and event which are in part at least financial character and interpreting the result thereon. Here, all things are first recording, classifying, and summarizing significant manner in terms of only money transaction. So, what is this transaction? Transaction means transfer of property from one person to another person is a transaction. What is transaction? Transfer of property from one person to another person is a transaction. There are two types of transaction. One is called cash transaction and is called the credit transaction. Transfer of goods from one party to another party for a cash, it is called cash transaction. Transfer of goods from one person to another person for a credit, he will say that I will pay your money after 10 days, after 50. It is called the credit transaction. So transaction includes, one is called cash transaction and is called the credit transaction. So here money transaction means like this, and the event which are in part at least financial character. We are talking only in the financial character and interpreting the result thereon. Then what are the features of accounting? Recording and maintaining of day-to-day business transaction systematically and scientifically under a particular set of books. So every day, whatever the transaction that will be entered day-wise, month-wise, year-wise, systematic arrangement, giving the result of business transaction at the end of the accounting period. If the records are made, so whatever we can say that the end result, we can find out at the end of the year what is the position of their financial position, fulfilling all the status requirement regarding the maintenance of books of account. Maintenance of books of account, one of the best theoretical way so that we can arrive the result at the end of the year, how the transaction takes place, which transaction has been taken place, is a credit transaction or a cash transaction. Then making internal and external and reporting. So they will enter the internal transaction also, they will enter the external transaction also, and also reporting to the management what is happened during the particular month, during the particular year. Then what are the objectives of accounting? To maintain proper records of business transaction, to ascertain the profit or loss of the business. This is important. To know the sources of revenue and the items of expenses, to ascertain the financial position of the business. First, proper records has to be maintained. Second one, to ascertain the profit or loss at the end of the year. It may be profit or it may be loss. To ascertain how much revenue you got, what are the expenses you have got at the end of the year. We want to know the ascertain the financial position of the business. How much asset you are having, how much liability you have to pay. It shows the financial position. Then, meaning of accountancy. Accountancy refers a systematic knowledge of accounting. It explains why and how to prepare the books of accounts and how to summarize the accounting information and communicate it to the interest party. So here the accountants is they prepare the books of account and see that it should reach the interested party. Definition of accountancy: according to Eric Kohler, accountancy is theory and practice of accounting. What is accountancy? Accountancy is the theory and practice of accounting is called accountancy in simple form. Then fundamental principles of accounting. There are three principles. One is called personal account, one is called real account, one is called the nominal account. Personal account. A personal account is one which deals the accounts of person. The name: Raju's account, X account, Y's account, Ramya's account, Canara Bank account, salary payable account. All these comes in name, only name. Raju's account, bank account, X account, Y's account. A personal account is one which deals the accounts of person. So the rules of the personal account here in accountancy: one is the debit side, another is the credit side. Left side is called debit side. This is called LHS. This is called RHS. What's the rules? Debit the receiver and credit the giver. The person one who gives, his account should be credited. The person who receives, his account should be debited. Here the major point: no, seller will prepare purchaser account and purchaser will prepare seller account. You must be careful. Purchaser will prepare seller account. Seller will prepare purchaser account. What's the rules? Debit the receiver and credit the giver. So it connected to only person. Real account. A real accounts are accounts of asset owned by business concern. For example, cash, furniture, goodwill, land, building, machinery, furniture, motor car. What's the rule? Rule of account. Debit what comes in, credit what goes out. If the building is sold, what is coming in? Cash is coming in, building is going out, cash should be debited, building should be credited. So furniture is coming in, cash is going out. Furniture should be debited, cash should be credited. Real account. Debit what comes in, credit what goes out. Then nominal account. A nominal accounts are the accounts of expenses, losses, and gains and income. It gives the respective income of expenses and losses. Rule: debit all expenses and losses, credit all gains and income. If the rent paid by chance, it will come on the debit side because it is an expenditure. Only nominal: rent, salary, printing and stationery, postage, general expense, all these items will come here. Rules is debit all expense and losses, credit all gains and gain. So which are the three accounts are? Accountancy can be broadly divided into three groups. One is the personal account, real account, nominal account. A personal account is one which deals the accounts of person. A real account is one which deals the accounts of the property. A nominal account is one which deals the accounts of profits or losses. What is the rule for was personal account? Debit the receiver and the credit the giver. Real account: debit what comes in, credit what goes out. Nominal account: debit all expenses and losses, credit all gains and income. We move on. Accounting cycle. First, we have a business transaction. Then it is entered to subsidiary book. What are the subsidiary books are? Purchase book, sales book, purchase return book, sales return book, cash book, bill receivable book, bills payable book. From subsidiary books to it will go to ledger, ledger to trial balance to final account. This is our accounting cycle. What is the first one? Business transaction. Business transaction goes to subsidiary books, subsidiary to ledger, ledger to trial balance to final account. If you ask in a business cycle, you have to write this one. Then accountancy, accounting principle which constitute the body of the doctrine associated with the accounting serve as an explanation of the current practice. Whatever the current practice way, that is going to be explained. The accounting principle mainly classified into two groups: accounting concept and accounting convention. We'll deal separately what is concepts and convention. Advantage of accounting: it helps to record all the transactions related to business for a particular books of account. We prepare all the record for a particular year, date-wise, month-wise, year-wise. It helps for preparation of financial statement. So what is the value of the asset? What is the value of the liability? What is the position of the company? It helps to comparison result by using the financial statement. So we'll prepare the financial statement. We compare to last year to the current year, whether we have been improved or not. It helps to prepare records to become the evidence in the court of law. So in the court of law, if they have got a doubt, any case, the records will be whole gold. Provide financial information to related parties such as owners, employees, customers, and government. It provides financial information. All the information is provided by accountancy to whom? It may be owners, it may be employees, it may be customer, it may be government. Accounting information helps the tax authority for settlement of tax matter. Any tax matter depends upon how your accounts have been prepared. They will know the position of the company. According to the position, we will pay the tax. Accounting information helps in measuring the value of the business in case of sale of an entity. So if they want to make the sale, the recording shows what is the value of the particular asset and particular liabilities. Disadvantages. It will record the only measurable in terms of money only. So they will record only in terms of money only. So there is no question of credit transactions are very less. It will not record non-financial transaction. It will enter only financial transaction. Non-financial transaction will not be entered. In this, certain data are recorded based on estimates and of the accuracy of records may not be possible. Sometimes the accuracy of accounts may not be possible here. There is a possibility of bias in the accounting information due to accounts influence. By influence, no, sometimes the record may be in the chain because no bias means it may be changed because of the influence. The accountant may be manipulate the profit of the business. So the accountant may manipulate the profit of the showing the more profit to the outsiders. The value of the money keeps changing due to inflation. The accounting information will not show the true economic position of the company. So whatever the financial position shown by the accountancy may not be perfect. So there is something goes all wrong here. That's why the disadvantage. You may believe, you will not believe. Hope we have done the basic of what is accountancy, what is an account, what is a business cycle, what is a business transaction, what are the advantages of accounting, what are the disadvantages we are dealing in this session. In the next session, we'll go with the concepts of accountancy. What is the concept of accountancy? Concepts and convention. Till then, goodbye. Meet in the next session with concepts and convention. Till then, goodbye.